Joining us right now to talk about this and so much more is Kevin Geddes, president of Fixed Income Capital Markets at Raymond James. Also Michael Taylor, chief investment officer at Eastern Bank Wealth Management. Looks like the markets this morning moving on the hopes of a China trade deal. I thought this was already baked into the cake that we were going to get something. I'm not sure why we're moving more on it. Does anybody jump ball to both of you? Maybe I'll go to Michael first. Why do you think this is happening?
Well, I think the markets are feeling pretty happy right now because the news coming on China trade deal is positive. You know, they're making progress. The problem is that something like that can change in an instant, and I think investors are being a little bit too happy about that right now. Same thing with Brexit, for that matter, which could have a big impact on, certainly on European stocks, could have a somewhat diluted impact here. But investors are assuming there as well that, well, probably the news will be okay. Probably they'll either kick the can down the road, because that's what American government and companies do. But they may be wrong. It may be a hard Brexit, and we aren't discounting that. So there's some risk there, but I think you're right that investors right now are looking for happy outcomes.
Okay, so but if you have this sort of glass half full, half empty view of things, what do you do about that?
I think the main thing you do is you recognize that between now and the end of April, a lot can change, and it could go either way. But in the long run, if you're an equity investor, if you're investing in stocks, then you're betting on companies, and you're betting on the financial health of American corporate enterprise, which is very strong. And so the earnings growth, yeah, it's going to slow down this year, but I think that the valuations reflect that. And you can say, I'm going to stay fully invested. I'll ride through the ups and downs, because there will be a lot of both this year. But you stick with it, and in the end, you're going to be fine. This is a resilient market.
Kevin, how did you read, you know, we're watching the futures, and they're not really moving on a percentage basis too much, considering we could be on the cusp of some sort of a deal. And I'm wondering how you read the FOMC minutes. It seemed like the Fed continued its dovishness. It indicated that it could end the continued roll-off of the balance sheet later this year. But Scott Minerd of Guggenheim had an interesting take. He said and tweeted that Fed officials see continued sustained expansion, which suggests that rate hikes could resume in the fall. Would that be good news or bad news for the markets?
You know, for the bond market, it's always going to be about inflation and whatever the Fed's doing. So if there's a bit of a disagreement between what economists think the Fed is going to do later in the year and what the market thinks the Fed's going to do later in the year. So I think, you know, a trade deal really could change this. It could be the savior of the U.S. economy. It could be something that drives rates higher. But we've seen it before, and if it's just, as Michael talks about, one that kicks the can down the road, it's not going to put great pressure on rates. So we're you know, all of this is predicated on the economy being about where it is, inflation not accelerating, and that the Fed remains on the sidelines. The minutes only bolstered that. They talked about China, they talked about a trade deal, they talked about Brexit, and none of those things have really changed so far. I don't see a big move in rates either way.
I'm glad you mentioned the disparity between what the economy is indicating, what the stock market might be indicating. I mean, if you take a look at the various asset classes, an investor would be getting very, very mixed messages. You've got the 10-year yield extremely tame. You've got commodities market on the rise. You've got a stock market that's on the rise. Kevin, which asset class is telling us the true story of what is going on?
Well, I think that remains to be seen. I think the market's saying there'll be 0 rate hikes in all of 2019, and the next move is going to be lower in 2020. So those investors have been putting more assets further out on the duration curve and still investing in quality. I think, you know, something big would have to change that thought right now, and I just don't see it. So I think the favored trend is if you were in 3 to 5 year durations, you're at 7 to 10 year durations, still invested in quality.
Okay, real quick, Michael, just back to you, and again, back to the FOMC minutes, because I'm curious how you think both about what the Fed's going to do and what it's going to mean to equities. I thought the most interesting part of those notes, though, of those minutes, was the idea that it wasn't really about the U.S. economy at all. It was about basically everything else that was going on, sort of these sort of existential issues and how they're thinking about that. I thought that was new.
It's a global economy, and the interconnectedness of supply chains around the world really matter. And the Fed's pretty wise to be thinking about that, because although we think of ourselves as a mostly closed economy, we are very much affected by all those factors. So I'm glad that the Fed was aware of that.
But the argument you just made about being in the stock market was actually to think about. It sounded to me like you were saying you got to just look at how strong the U.S. economy is. And what it seemed like the Fed was saying was we may be strong, but everything else may be going to hell in a handbasket, and that may ultimately put us in a more challenged place.
We need to look at how strong U.S. companies are. They're operating globally, and they depend on supply chains that are absolutely global. So, yeah, the U.S. economy is still the biggest piece of that, but it does matter what's happening overseas as well.
Okay. Michael, thank you. Michael Tyler of Eastern Bank Wealth Management, Kevin Gittes of Raymond James. Thanks, guys.
Coming up, Pinterest is cracking down on anti-vaxxers. That story's next. Then our guest host this morning will be